John Lonsky, stocks were strong in Q1, earnings were strong in Q1, but the economy only grew about 2.2%. What's your view?
We believe that the economy will continue to grow, and that's very important. However, in a relatively modest range of 2 to 2.5%, we're not seeing that very strong growth that followed the recession, the deep recession of 1981-82, when in 1984, GDP soared higher by more than 7% annually. And moreover, I'd like to add, though earnings have exceeded expectations for the first quarter thus far in balance, the reality is earnings growth has slowed. Last year, operating earnings for S&P 500 non-financial companies is 16% year over year, quite good. Thus far in the first quarter, that growth rate has eased to approximately 5%. And that worries us going forward. Could it be that profits continue to decelerate? And if that's the case, we could run into some difficulty in 2013.
Well, will we run into additional quantitative easing from the Fed? Will that sort it out?
I'm not going to dismiss that possibility. We could right now be in the position where we're going to look back and say, well, it was deja vu all over again. We got off to a strong start in 2011. Then because of Europe and other factors, the economy faltered and we had Operation Twist. And it could very well be that if the equity market softens by enough to frighten Fed policymakers, we could be looking at another extraordinary effort on the part of the Federal Reserve to lend buoyancy to the economy.
Well, it's nice to know that Bernanke put is there. But is the average American consumer feeling more confident because stocks have moved higher?
Well, indirectly, yes, I think that's very true. Right now, because of the fact that 1/4 of all mortgages are underwater, because of the fact that the weakening of household balance sheets has been felt most severely by households with middle incomes and lower, like never before, U.S. consumer spending is leaning on financially stronger households that tend to have higher incomes. And what we've seen over time is that consumer spending has become increasingly sensitive to the behavior of the equity market. So it's imperative that the equity market not fall off a cliff if we are going to avoid a stalling of the economy.
Taking this view into account, how should someone invest in this environment?
Well, I think the first rule you could go by is that interest rates are going to remain relatively low for perhaps longer than what we currently anticipate. So it's highly unlikely that a spiking of interest rates will at any time in the near future prove disruptive for the equity market. That being said, we still have to be sensitive to this ongoing slowdown by profitability. All of that, with all of these warnings, I still think there's perhaps a 5% upside for the market value of common stock, but I would pay special attention to the situation in Europe and how that affects the credit spreads of high-yield companies and especially investment-grade banks. If we can keep those spreads from widening, better yet, if we could somehow have these spreads narrow, it's a positive for equities. And moreover, we have a presidential election coming up. I wouldn't be surprised if the market remains choppy until uncertainties surrounding the outcome of the November elections are resolved.
This market is
Stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to